Have you ever wondered why investing feels so difficult? With too many choices, too many risks, and too much information to process? In this video, we're going to talk about ETFs, which can provide a simple and investor-friendly way to invest in a diversified portfolio. We'll break down ETFs in a simple way, starting with market indexes, index ETFs, and leveraged ETFs. Then we'll look at the key benefits, risks, and common mistakes investors should understand. By the end of this video, you'll have a clearer understanding of how ETFs work and how they fit into the investing world. Let's get started with learning about ETFs. Please note that this video is for learning purposes. It is not financial advice. Investing has many downside risks. Please perform additional research before investing. Now, let's look at the problems faced in traditional investing without using ETFs. Traditional investing can feel confusing because there are so many choices, including stocks, bonds, and commodities. It can also become hard to diversify because building a balanced portfolio may require buying many different assets. Investors may also face problems such as higher costs from buying and managing many separate investments, time-consuming research when comparing different companies, and limited access to international markets. Investing without ETFs can also create more complexity in managing the emotional decisions caused by sudden market swings. To understand ETF investing, we first need to understand what an ETF actually represents. ETF stands for Exchange Traded Fund. In simple terms, an ETF gives investors access to a group of assets through one investment product. An ETF is like a basket of investments inside one fund. ETFs can include stocks, bonds, commodities, or other investment categories. They also trade on an exchange, similar to how a stock trades. Many ETFs are also professionally managed or maintained by a fund provider. Since many ETFs follow market indexes, it helps to understand what a market index is. A market index measures how a group of companies or investments is performing. Instead of tracking just one stock, it tracks many investments together to show the direction of a market, sector, or asset category. If the investments in the index rise, the index usually goes up. If they fall, the index usually goes down. In simple terms, a market index is like a scoreboard for a specific part of the market. Now that we understand what a market index is, let's look at some common market indexes and examples of non-leveraged ETFs. These examples are for learning purposes only and are not investment recommendations. Always do additional research before investing. The S&P 500 represents large U.S. companies across many industries. Two examples of ETFs that track this market are SPY, the SPDR S&P 500 ETF Trust, and VOO, the Vanguard S&P 500 ETF. The NASDAQ 100 represents major non-financial companies listed on the NASDAQ, with a strong focus on technology and growth companies. Examples include QQQ, the Invesco QQQ Trust, and QQQM, the Invesco NASDAQ 100 ETF. The Dow Jones Industrial Average represents a smaller group of large, well-known U.S. companies. An example ETF that tracks this index is DIA, the SPDR Dow Jones Industrial Average ETF Trust. The Russell 2000 represents smaller U.S. companies, often called small-cap stocks. Examples include IWM, the iShares Russell 2000 ETF, and VTWO, the Vanguard Russell 2000 ETF. The total U.S. stock market represents a broader view of the American stock market. Two examples are VTI, the Vanguard Total Stock Market ETF, and ITOT, the iShares Core S&P Total U.S. Stock Market ETF. Broad international stock markets represent companies outside the United States. For international exposure, examples include VXUS, the Vanguard Total International Stock ETF, and IXUS, the iShares Core MSCI Total International Stock ETF. Let's take a look at how ETF funds are managed. A fund provider creates and operates the ETF, deciding its structure and objectives. The ETF holds a portfolio of investments, such as stocks or bonds or commodities, based on the index or strategy it follows. Over time, the holdings may be rebalanced to stay aligned with that target. The goal is perform regular tracking to help the ETF closely match the performance of its underlying index or investment objective. Now, let's take a look at what are leveraged ETFs. Leveraged ETFs are designed to amplify the daily movement of an underlying index. For example, on a trading day, if the index goes up by 10%, a regular 1x ETF would also go up by about 10%. A 2x ETF is designed to move twice as much, so it would go up by about 20%. And a 3x ETF is designed to move 3 times as much, so it would go up by about 30%. But it is important to remember that this example is only for one day's index movement. Across multiple days, leveraged ETF performance may not follow the same simple pattern because these funds reset and rebalance daily. Before investing in leveraged ETFs, it is important to understand the downside risks. Leveraged ETFs can amplify gains, but they can also amplify losses. For example, if the underlying index drops by 10% in a day, a standard 1x ETF may drop about 10%. A 2x leveraged ETF may drop about 20%, and a 3x leveraged ETF may drop about 30%. This means that a 10% single-day decline in a market index could lead to much larger losses of around 20% in 2x ETFs and 30% in 3x ETFs, making them significantly higher risk investments. In addition to the normal ETFs that follow the index movement, there is another type of ETFs called inverse ETFs that are designed to move in the opposite direction of their underlying index on a daily basis. For example, if an index gains by 10% in a single day, an inverse 1x ETF may decline by approximately 10%. An inverse 2x ETF may decline by approximately 20%, and an inverse 3x ETF may decline by approximately 30%. On the other hand, if an index declines by 10% in a single day, an inverse 1x ETF may gain approximately 10%. An inverse 2x ETF may gain approximately 20%, and an inverse 3x ETF may gain approximately 30%. While inverse ETFs can potentially benefit from falling markets, they are generally considered highly risky investments due to factors such as amplification of losses and potential loss of value over the long term due to daily rebalancing. One of the very important concepts to understand with leveraged ETFs is the effect of daily rebalancing. A leveraged ETF may still lose value, even if the underlying index recovers back to its original value due to daily rebalancing. In this example, the index starts at 100, drops 10% to 90, and then rises 11.1% to return to 100, ending with no overall loss. But the 2x leveraged ETF drops more sharply on day 1, and even after the rebound, ends below its starting value. The 3x leveraged ETF experiences an even larger drop and finishes even further below where it started. This is why leveraged ETFs can lose value over time, even when the underlying index ends up unchanged. Before investing in ETFs, it is helpful to understand the common mistakes made by many investors. First, setting unrealistic goals can lead to poor decisions, such as expecting quick profits or unusually high returns without understanding the risks involved. Second, ignoring the risks, especially with leveraged or specialized ETFs, can expose investors to losses they may not be prepared for. Third, buying overlapping ETFs can reduce diversification because different ETFs may hold many of the same underlying investments. Fourth, buying complex ETFs without fully understanding how they work can lead to unexpected results. Fifth, investing without a clear plan can make it harder to stay disciplined during market ups and downs. And finally, ignoring fees can quietly reduce long-term returns, since even small costs can add up over time. Thank you for watching this video. I hope this knowledge will help you understand ETF investing more clearly. Please like the video and subscribe to the channel for more videos related to investing and finance. Also, please leave a comment below about what topic you would like to learn next, or any questions you have about stock market investing. Thanks again for watching, and I'll see you in the next video.